Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of August 4th, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was another roller coaster ride for mortgage rates. If you take a look at the bond chart on the screen, you can see mortgage rates were trending down. They tried to rebound, then they started trending down. Big red candle on Wednesday. Bonds sold off. That was after a very unexpected GDP report. Now, we were able to find a bottom on Thursday and rebound on Friday after the jobs report. So you can see, been on this up-down roller coaster ride. Got a big green candle on Friday. So we're going to recommend floating your Delaware mortgage rate to see if you can take advantage of this rebound again, climbing up the hill on the roller coaster. So we're looking to float the rate, see if we can build some momentum and see if we can get a slightly lower rate. Now, if we dig into the news, what caused that huge sell-off on Wednesday? Well, we had the gross domestic product report for the second quarter of 2014. The first reading surprised everyone. It came out at a positive 4% GDP. That's a huge rebound from the final reading of the first quarter, which was negative 2.1%. So that basically rocked the bond market. It sold off. And then if we dig into that GDP report, the big increase appears to be from increased consumer spending and from business investment, basically in inventory. So we're going to have to see how the GDP plays out, because the inventory is kind of a one shot in the arm. If there's no other factors that help, we're going to see a drop in the GDP next quarter. So we'll have to keep a lookout for that. Now, Friday, big report on Friday was the July jobs report for 2014. Much anticipated. Labor Department released that, and it showed 209,000 jobs were created in July, and May and June's jobs report were revised higher by 15,000 jobs. So the month average for 2014 is at 230,000 jobs, which is enough to support economic growth. Now, we did see the unemployment rate tick up from 6.1 to 6.2%, but that's what we would expect on an improving economy. We would expect people that have stopped looking for work, not counted, going back looking for work, so they would now be counting the unemployment rate. So that's what we would expect that as the job market improves. Now, when you dig into the fundamentals of the report, this was probably the best report all year, because it showed most of the jobs were actually created with people that had college degrees and was full-time employment. Those are the jobs we need to keep the economy on track. And if you dig further in the report, full-time jobs compared to part-time jobs were 4 to 1 more. So it's been part-time's been ruling the report. So now full-time. So great jobs report. And we even saw labor force participation rates actually tick up from 62.8 to 62.9%. So all in all, good jobs report. If that continues, it'll be a good support for the economy. Now, the Federal Reserve had their meeting on Wednesday as well. Well, it's Tuesday and Wednesday. Released the minutes of the meeting on Wednesday, and they basically did what we were expecting. They're going to continue to taper their asset purchase program, QE3. So they're cutting another $10 billion a month that they're actually buying. So they're going to drop from $35 billion to only $25 billion a month in asset purchases starting in August. So that's between bonds and treasuries. They are planning on ending that program this year. They've been saying it all year. They've been dropping it $10 billion, $10 billion. So the next meeting, they're probably going to drop it again, another $10 billion. Now, we also saw that the weekly initial jobless claims came out on Thursday. They did tick up to slightly higher than 302,000 claims, but up from 279,000 claims the previous week. But jobless claims have been hovering around the 300,000. That's a new low for jobless claim. Good sign for the labor market. And then in a huge report, Consumer Confidence Index actually surged to a 7-year high of 90.9 for July 2014. That's up from 86.4 for June. That's the third consecutive month of gains in consumer confidence. It's the highest level since October 2007. So the gains in the labor market have fueled the increase in consumer confidence. That's good news there. Now, USDA update. USDA Rural Housing just released last week an update to their mortgage insurance program. Currently, if you get a USDA loan, you have to pay a 2% upfront guarantee fee, and they charge you monthly mortgage insurance based on a yearly amount, a factor of 0.4%. Well, beginning October 1st, 2014, they're keeping the guarantee fee the same, but they're going to increase the monthly factor from 0.4 to 0.5%. So it's not a huge increase, but a slight increase. The USDA announced that last week. So if you don't have your commitment from USDA by October 1st, if you get the commitment after that, you'll be on the new premium of 0.5%. So keep a lookout for that. Now, on the local news, the next first-time homebuyer seminar is coming up Saturday, August 16th in Dover, Delaware from 10 a.m. to noon at the Dover Holiday Inn right there on Route 13. And then the next one in Newark is Saturday, August 23rd from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.